Forex trading indicators for beginners. Top picks. Forex trading indicators are tools used by traders to analyze market conditions, identify trends, and make informed trading decisions. They help traders spot potential entry and exit points and provide insights into market dynamics. As a beginner in Forex trading, it's essential to understand and utilize some of the popular indicators available. Here are a few top picks. Moving average or MA. Moving averages are widely used indicators that help smooth out price data and identify trends. The simple moving average SMA calculates the average price over a specified period, while the exponential moving average EMA gives more weight to recent prices. Traders often use the crossover of different moving averages to identify trend reversals and generate trading signals. Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100 and helps identify overbought and oversold conditions in the market. A reading above 70 indicates overbought conditions, while a reading below 30 indicates oversold conditions. Traders use RSI to spot potential trend reversals and generate buy or sell signals. Stochastic Oscillator. The stochastic oscillator is another momentum oscillator that compares the closing price of a currency pair to its price range over a specified period. It helps identify overbought and oversold conditions and generates buy or sell signals based on the crossing of the %K and %D lines. The stochastic oscillator is particularly useful in range-bound markets. Bollinger Bands. Bollinger Bands consist of a moving average, usually the SMA, and two standard deviation lines placed above and below it. They help identify volatility and price extremes in the market. When the price touches or crosses the upper band, it may indicate overbought conditions, while touching or crossing the lower band may suggest oversold conditions. Traders also look for the squeeze, where the bands contract, indicating low volatility and potentially signaling an upcoming price breakout. MACD, or Moving Average Convergence Divergence. MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a currency pair's price. It consists of a MACD line, a signal line, and a histogram. Traders look for the crossing of the MACD line and the signal line, as well as changes in the histogram, to identify potential trend reversals or continuations. Fibonacci retracement. Fibonacci retracement levels are not traditional indicators but are widely used in Forex trading. They are based on mathematical ratios that help identify potential support and resistance levels in the market. Traders use Fibonacci retracement levels to identify areas where price corrections may end and the trend may resume. Ichimoku cloud. The Ichimoku cloud is a comprehensive indicator that provides information about support and resistance levels, trend direction, and momentum. It consists of several components, including the cloud, or Kumo, Tenkan-sen, Kijun-sen, and the Chikuspan. Traders use the Ichimoku cloud to identify trend reversals, confirm trends, and generate trading signals. It's important to note that while these indicators can provide valuable insights, they should not be used in isolation. Combining indicators and using them in conjunction with other forms of analysis, such as price action and fundamental analysis, can help validate signals and enhance trading decisions. As a beginner, focus on understanding the basics of each indicator and practice using them on demo accounts before applying them to live trading. Experiment with different settings and combinations to find what works best for your trading style and preferences. Remember that indicators are tools that assist in analysis, but ultimately it's crucial to develop a deep understanding of the Forex market and cultivate your trading skills.